Alright everyone, welcome to the second episode of the No BS ICT Explain series. In this episode we are going to talk about pairing higher time frame analysis with institutional order flow. Remember guys, download the notes, follow along, take your time, rewatch the video or any part of the section. And if you're struggling with anything and if you have any questions, please let me know in the comments down below. Like and subscribe, ladies and gentlemen. These videos are not easy to make. Other than that, let's get started. So, what is institutional order flow? Let's imagine you're at a school fair. There are many stalls selling different things like toys, food, and games. Now imagine there's a very popular toy stall that everyone wants to buy from. This stall is like the stock market. The institutional order flow is like the line of adults who are like the big banks waiting to buy toys. They have a lot of money and can buy a lot of toys, so their decisions can change which toys are popular. The inner circle trader, or ICT, is like a smart kid who watches what these adults do. This kid doesn't just join any line. They watch where the big buyers go, what they buy, and how much they buy. Then they make their own decisions based on this. They might join the line where they see a big buyer because they think that the toy will become more popular. So in simple terms, institutional order flow is watching the big players in the market, watching them do what they do, and ICT is making trading decisions based on that. Alright, so what to look for? Price looks for liquidity voids and seeks to rebalance itself from every impulsive move that it does. So when you mark up your chart, keep those key levels in mind. So as you can see here, price is coming down, right? And as it's coming down, it sweeps a point of interest or some liquidity, however you want to look at this. And what does it do? It comes back, rebalancing itself, right? Filling in any gaps, tapping into any order blocks that it needs to tap in. And then what does it do? Starts moving down, taps into another point of interest, comes back up, rebalances itself or starts filling any gaps, taps into again another point of interest, and then starts moving down impulsively, right? Now, remember, if you're going to look for sells, always look to sell from a premium area. And if you are looking to buy, do it from a discounted area. Here I have my fib drawn, and as you can see, I have the 50% level here, right? So anything above the 50% is considered a premium area, and anything below it is considered a discounted area. So like I said, if you want to look for sells, look to sell from an area that is in an area that is considered to be premium, and if you're going to buy, look for an area that is considered to be discounted, right? Now don't just buy or sell because it's in one of these areas. You obviously want to look for reasons to actually get into the trade as opposed to just getting in just because it's simply in one of these areas. Lastly, look at price as if you're reading a history book, outlining every single detail from the past all the way to the present to predict a future. Now we are going to take a deeper look into institutional order flow, and in this part I really need you guys to pay attention. I mean, truly pay as best attention as you can, because it can get a little difficult for anyone new to ICT or anyone just new to trading in general. So take your time, but please pay attention. Alright, so we're going to start with top-down analysis ICT style. The first one is using the daily chart. Use a 12 to 9 months view. From there, you drop down to the 4-hour chart using a 3-month view. Thirdly, you drop down to the 1-hour chart using a 3-week view. And lastly, you drop down to the 15-minute chart using a 3 to 4 day view. Now, you might be asking yourself, what the heck do I do in each one of these charts? Well, you're going to be looking for areas where price shows strong or quick movement from a level. Secondly, you will be looking for recent highs and lows that have yet to be retested. Thirdly, make notes of days or areas where the weekly highs and lows are located. Just mark them out, draw a horizontal line because that could be seen as liquidity. Fourth, make note of the daily high and low located in a kill zone. Now there's an indicator that you guys can use for your kill zones. I will be talking about kill zones later on down the series. The video probably came out by now, but just in case, just do a little bit of research, figure out which time the kill zones fall in, and just mark out your highs and lows for the day. Now if you are struggling, I already made a video specifically on top-down analysis with a more SMC approach, which is, to be honest, kind of the same thing as what ICT does. But you can just look up this video right here, click on this link, and it'll take you to the video I made. You can use that as part of your top-down analysis for these time frames. And this indicator right here is actually really cool because it'll help you look up for buy side, look what buy side liquidity is located. As you can see, there's sell side liquidity here. It does a pretty good job, so I recommend it if you're starting off with as a beginner. I think it's worth checking out. But yeah, let's move on. All right, noting impulsive price swings. Important price swings. These important impulsive price swings occur during New York and London session. Why? Because there's lots of liquidity and gaps or imbalances that get taken and filled during these sessions. Now you should look out for something called retractions. A retraction is essentially a fake out, taking out traders and then returning to its intended direction. This usually happens around the beginning of any day or any session. Example, you can have retraction as the day opens, then one before the London session, and then one before the New York session. Now, retractions can happen anytime, guys, at any point, at any moment, on any time frame. Just keep an eye out for them. And in a minute, I'll show you an example, but I just want to make it very clear that retractions are definitely something to look out for. Okay, so here for this example, I have the gold dashed lines representing the midnight open, and then the blue lines equal the high and low of the day or of the session. And for this example, we're going to be on the 1 hour time frame. So as you can see, for this day we have the low here and the high here. The next day, here's the highest point, here's the lowest point, and then the day after that is the highest point here and the lowest point being down here. Now in the example that I was talking about earlier, where we have retractions, this right here, this sweep of the previous high, that is a retraction because not only did it sweep that previous day's high, but it started moving down impulsively into its intended direction, right? It's really that simple. There's nothing too complicated about this. You can find this on any time frame, on any asset that you trade. You just have to be very, very careful and to try to mitigate this. You can also try using different time frames, going on a higher time frame, whether it's on a weekly or even a monthly, just to see where the overall intended direction of the market is going to be. Okay, let's talk about retail traps. Let's break down the retail day trading traps discussed by ICT in a simpler way. Imagine you're in a market full of twists and turns, and sometimes there are traps set by the big players called market makers. So these traps often happen when you see common patterns like flags or head and shoulders near key zones where a lot of buying and selling is happening. Now, keep in mind, it can be any kind of pattern. This type of buying or selling is happening known as liquidity zones. For example, you might spot what looks like a bullish flag pattern. The market makers might be making it look like the price is going to shoot up, but the real plan is to get it into an area where a lot of transactions are happening and then quickly sell off. Similarly, with a head and shoulders pattern, if it's forming near a liquidity zone, it might seem like the price is going to drop. The market makers, however, might just be trying to get it there to take advantage of the high trading activity and then move it in the direction they want it. To make it clear, if you're a trader using price action and recognizing these patterns, be cautious when you see them near liquidity zones. It's like being aware that there might be a hidden trap. The idea is that these patterns could be set up by market makers to lure traders into making moves that benefit the big players, but could lead to losses for individual traders. In short, these traps are rare but often happen in areas of significant trading activity. So if you're spotting these patterns, especially near places with a lot of buying or selling, be on guard. It could be a trap. Okay, so for this example, I have a chart pattern here, and what some people would usually do is wait for a breakout of this pattern, right? They would maybe wait for 1 or 2 candles to break out, then they'd put their stop loss either at a fixed pip size or under the most recent low that they could find. And then the problem becomes that if you look for trades near areas of liquidity, sometimes after that liquidity gets taken out, price will then reverse, either to make a retracement or to change its direction. And this is just something that's very common regardless of whether you're trading chart patterns or not. Trading where price is already near areas of liquidity is very, very dangerous, especially if you're on the higher time frame. So just keep that in mind anytime you're planning on entering trades. Make sure that you are not near an area that is considered to be an area of high liquidity or liquidity pools. Okay, so for the indicators, these 3 indicators are going to help you out marking your charts up. The first one will help you mark up your midnight open. The second one will help you mark up your previous daily and weekly highs and lows. And this last one will help you with your ICT analysis. So when you're marking up anything with liquidity, anything that has to do with some breaks of structure, imbalances, stuff like that. These are very easy to use, very simple indicators. Or if you just want to do it all on your own, I highly recommend that, especially if you want to get this down without relying on any indicators. Okay? All right, everyone, so thank you so much for making it to the end of this video. I hope that you guys liked it. Please like and subscribe. Push me through this algorithm. And if you have any questions, comments, or concerns, please let me know down in the comment section and I will do my best to answer. And as always, I have a quick Bible verse for you. This is from Psalm 118:24. This is the day the Lord has made. Let us rejoice and be glad in it. Whatever it is that you guys are going through, I hope that it gets better for you guys. I hope that you get the answer to whatever it is that you're praying for. And I hope that you all become blessed traders. And remember, trading is subjective, but God is not. I'll see you all in the next one. Peace.